Today I'm going to jump on twice because of the news we had to come out on the bonds, and we finally have a movement of difference. The ISM report came out and it was strong. It was very strong, unexpected by the market, okay? And so what happened was there was a response in our bond market. And as you can see, the 10 years now is 469. Actually, it was a little higher. You could have rounded up at 470. Remember, yesterday in the video was 462. Okay, that's the first thing. The second thing is our 30-year went to 492. And if you look at this chart, you can see it's breaking out. And in fact, there's some chartists. I'm not a chartist. Just said that he said in the next week or so you're going to see the 30-year break 5%, which, as you know, is our target. We're going to break 5% on the 2-year. That's what I believe. We're not the only ones moving up. These are the JGBs hitting. I know it's only 1.3%, but guess what? It's been the highest rate since 1998 or 99, I think. And here is the British gilt. It also hit a high from 1988 or 1999. We can flip them back and forth, either one. And then we all know that France is struggling. Their yields now are higher than Greece, all right? And they have a 6% deficit for their government this year. So when you look around the world, all the government bonds are, what do you want to say, under attack? They're moving up. And so we're in a bear market, it seems, on global government bonds, all right? Now, the reason I jumped on here today is because our betting market, where the market bets on interest rate cuts, went to 0 chance of a cut in June. So that would mean that this market sentiment is saying that the very first cut that they can perceive happening won't be until September, all right? Now, why is that important? Well, think about when we started cutting the half and the quarter, okay? The betting markets were like, we're going to do this 4 times, 8 times, 6 times. We had people saying we should cut 153 times. So in other words, the Fed was, quote unquote, behind market sentiment, all right? Market sentiment was leading the way. Fact is it got to the point when it was like 6 to 8 cuts that it was almost like the market was pressuring the Fed to make a cut, right? So the Fed could cut. That's my point, all right? Now, think about it. Market sentiment is they're not expecting any cuts. And we have plenty of news items that can come out between now and, let's say, September, or even June, let's say September. And if we have a situation in the new administration, they're going to do tax cuts, they're going to put on tariffs, they're going to, I don't know, geopolitically, they're all over the map right now, so let's just wait and see what happens. My point is, we also have a treasury that has to roll $7 trillion. And if you followed my videos, you know that Percent, he was against what the prior administration did, where they took us from 20 to 24% issuance of treasuries, okay? So we have $7 trillion coming due this year, right? Now, all right? Plus, we have 2.5 to 3 trillion at this time, without any new things coming from the administration, of new debt that we have to do. So let's say around $10 trillion, no small thing. Now, Percent is very, very clear. He's like, we should have a, let's say, more balanced offering out there, treasuries, notes, and bonds. And so he's determined to issue bonds and notes. Well, that's the 2 and the 10. So not only do you have government yields going up around the world, not only do you have the markets believing there should be no cuts, we also have a government bond market that is going to be, I don't know what's a good word, aggressive, or a big player, or whatever you want to say, in the market. And not only that, they're changing the way they're going to issue them. Let's see if they continue. They may change that. And they're going to start hitting out at the longer end, which is where it's problematic for the economy, right? The short end is not problematic for us. When the long end goes up, guess what goes up? Your mortgage goes up, car loans go up, that's what goes up. So that's when it costs us money and it costs us the economy growth, all right? Now, what do we have to watch for? What is something that's out of the box that could actually happen here? And this is what it could be, right? And I'm not saying it's going to happen. We're going to watch and see what the narrative is. But could we get to the point where the old axiom, men propose and markets dispose? We can propose that we're going to cut taxes, we're going to do this, we're going to do that, we're going to put in all these tariffs, we're going to attack these countries. But in the end, the markets will tell us that they're going to allow us to do it. And right now, we have a high debt level, right? And it's growing all the time. And I don't know, what do you think? Are the markets going to allow us to do this? And if they do, where do we see interest rates going? Like and follow, and certainly let me know your comments.